Um, all right. Good evening, everyone. This is Author of One Smart Forest. I've actually recorded the class before, but the one I recorded was not producing sound. I just hope this will produce sound because I'm tired already. Like, I'm seriously tired. You understand? You know what that means. So, you know, there are three ways with which you can analyze forex trading. You understand? Like, if you want to take advantage of the market, there are three ways with which you can take advantage of the market, right? The first one is the technical way, you understand, which is known as technical analysis. And the second one is the fundamental way, which is known as the fundamental analysis. And the um, third one is called, and the third one is called the sentimental or sentiment, which is known as the sentimental analysis. So for the purpose of this class, I'll be talking about only technical analysis. And what does technical analysis mean? Technical analysis means actually you relating what has happened in the past to present because it is believed that we human beings we exhibit a phenomenon which is known as repetitive compulsion. Do you understand? And what does that repetitive compulsion means? It means that what we did in the past, we also repeat it in present. Do you understand? Because it is human being that treat this forex market, not witch, not demons, not um spiritualists. You understand? It's we humans, and that is why we relate what happened in it. That's why we relate what happened in the past to present, and that is the reason why we have support and resistance. We have key levels. You understand? Because those key levels and support and resistance are those ones that are actually helping us. The essence of those things is let's assume that like 5 days ago, when dollar got to 5 days, like 5 days ago, when dollar got to let's say $3. You understand? When CHFJPY got to like $3, it started selling. So now today, if CHFJPY should get to $3, there's possibility that it is going to sell too because like 5 days ago when it got there, it started selling. So that is the essence of relating what has happened in the past to present, and that is all you're going to be doing for the technical aspect. So straight to business before you can be able to analyze the before you can before you'll be able to analyze forex very well. Sure, you understand. There are some things that you need to know. Like we have some basics which you need to understand before you can be able to say, okay, I can analyze forex trading in the technical way. Sure, you understand. Among those things that you need to know is the market structure. It is very important. And for you to know market structure, market structure is subdivided into three parts in which I'm going to take you. You understand? Um we have the trending market, like market structure. You understand? You need to understand where market is heading to and how market is just like it is just like you going to maybe a shoe market. You understand? You know that okay, in this market they sell shoes alone and stuff like that. That is how you need to know the type of market you are actually going to, and it is very important. So the first one that we have is what a trending market. A trending market. And the next one that we have is a ranging market. The next one that we have is ranging market. The next one that we have is a choppy market, in which we don't take advantage of. Whenever you spot a choppy market in forex, all you have to do is just to leave trading at that moment. Like I said, I'll be starting with a trending market. Trending market is subdivided into two. We have the upward trend and a downward trend. From the term trending market, you know that okay, this thing is actually trending towards a particular direction, which could be the upward trend or the downward trend. Can you understand? So when you are talking about a downward trend, it means that okay, market is actually going down, and there are two things that you need to look out for on a downward trend. You need to look out for what? need to look out for a lower low and a lower high. Just like in the case of this, can you see the market is going down? That shows that okay, this is actually a downward trend. Shey you understand? So that is how to get a downward trend. And what do I mean by lower highs and lower lows? Lower highs and lower lows are formed. We form a lower high whenever market pulls back or form a corrective move. Now, this is an impulsive move. After an impulsive move, it is expected that okay, market should just go up to form a corrective move because forex market is not linear. Can you understand? After an impulsive move, the next thing is what is a corrective move, then an impulsive move, then a corrective move, then an impulsive move to the downside. Can you understand? So forex market, forex market is not linear. It is not something that we just continue going straight, straight, straight. That is why we have the pullbacks. So some people call this pullback. They call it pullback. This one, all these ones, they call it pullback. Those ones that I called a corrective move, people actually call it pullback or a retracement move. Do you understand? They call it pullback or a retracement move. That is what they call them, pullback or retracement move. But they are actually corrective move because it is said that okay, whenever market moves, maybe moves like this to the downside, the market is going to get tired. You understand? It has to correct itself, then come down, then go up to correct itself again, then come down. Do you understand? That is why we have the impulsive and the corrective move. So now the next thing I'll be talking about under the trending market is the downward trend. Let me show you. Sorry, it's the upward trend. I've spoken about the downward trend. So now this is an upward trend. When you look at it very well, and you see the market is heading towards the upside. Look at it. But when you look at it, you can see some pullbacks. Because why are you seeing those pullbacks? That's because market is not what is not linear. Do you understand? That is the reason why. Look at this one now. It went up, pulled back, or corrected itself, went up, corrected itself, went up, corrected itself, went up, corrected itself, went up. So now, after you've been able to, after you've been able to identify, after you've been able to identify, um, after you've been able to identify those structures, they are like you know that okay, this thing is actually heading towards the upside. So there are two things that you need to look out for so that you'll be able to take the advantage. For an upward trend, you need to look out for what is known as high highs and high lows. Do you understand? This is an high high. Let's use this swing guy, high high, and this is what an high low, and this is what an high high, and this is what an high low, an high low. But for all these things, there are rules. Now we've been able to get our high low, high low. You will notice that I did not make use of this example. Why didn't I make use of this example? Why didn't I start it from here? Like why didn't I use all these ones as my upward trend? This is the reason why I didn't start from here to start labeling from here. Why? Because it is said that the next high low should not be lower than the previous high low. If you look at this one very well, it came all the way down to clear these lows. That means this is not an high low because this has already pulled back more than the previous one. So it has violated the rule. Look, if you look at this high low, it did not go below the previous high low. So that is why the upward that's why I would say okay, the upward trend actually started from here to here. So that is how to go about that, about the upward trend. Can you understand? Then the next high should also be higher than the previous high. Look at it very well. This high is lesser than this next high. So that is how to go about identifying the structure for an upward trend. The next high low should be greater, like should be higher in market than the previous high low. So you understand? And the next high should also be greater than the previous high low. Now let's go on a downward trend to label downward trend. So now on a downward trend, there are two things that you also need to look out for. You need to look out for what is known as lower highs and lower lows. Do you understand? Lower highs and lower lows. Those are the things that you need to look out for on an upward trend. And on an upward trend, after this pullback now, like okay, fine, you've gotten this pullback here. You've gotten this pullback here. What do? You buy. You should always look out for a buying opportunity at your high lows, at the formation of your high lows. You should always look out for what? A buy opportunity, because you are on a buy on so you are on an upward trend, because market is going up. You should not, it is not advisable for you to be selling on an upward trend. On an upward trend, you should always look out for a buy opportunity, because if you are looking out for a sell opportunity on an upward trend, that means you are going against the market trend, which is not supposed to be. That means you are trading against the market. You understand? It's just like you going to somewhere and you are walking with your back. You are not facing front. You are using your back to walk. So that means you can easily jam anything. Can you understand? Anything can injure you, because you actually don't know where you are. You are going. You don't know where you are going to, because you can't see. So that is why it is advisable for you to always look for a buy opportunity on an upward trend. Then when you are on a downward trend, you should always look out for a sell opportunity upon the formation of your high lows, of your lower lows or pullbacks or retracement or corrective, or whichever way you call it. You understand? So let's label the downward trend. On the downward trend as well, there are also two things that you also need to look out for. You need to look out for your what? Your lower highs and your what? Your lower lows. Your swing highs will be your lower high. This LH means lower high. LH means lower high. So why this one now means lower low? Lower low. Then this one now will be your what? Lower high. The retracement or the corrective move or the pullback is your lower high. And what do you look out for on those lower high formations? You look out for a sell opportunity, because you are on a downward trend. On a downward trend, you should always look out for what? You should always look out for a sell opportunity on a downward trend. You should always look out for what? A sell opportunity, and this is what? A lower high. So on a downward trend, you should always look out for a sell opportunity. So the next one I'm going to talk about now is what is known as the ranging market. From that word ranging, that means it is ranging. If something is ranging, that means it is moving about that same position. Can you understand? So it is either called a ranging market. It is either called a ranging market, or a sideways market, or a consolidating market. So now from that word sideways, it means they are by each other side. And on these ones too, there are also things that you need to look out for on the ranging market. You need to look out for what? You need to look out for support and resistance. Whichever one that is at the top, or like whichever one market is below, is known as your what? Is known as your resistance. And whichever one that market is below is known as your what? Is known as your support. Whichever one the market is above, like this one now, market is above it. That is why it is being called your support. Can you understand? It is called support. Let me label it for you. But there are levels to these things. So before you can say something is actually a support, that means market must have touched it. Can you understand? Market must have touched it more than 3 times. Sorry, market must have touched it more than 2 times. But for you to say you actually have a valid support or resistance. Market must have touched it. This is your resistance. Market must have touched it like 3 times. So now when we look at this that we call our support, this is what I mean by market touching. Those candles or bodies of the candles touching it. Can you see? 1, 2, 3, 4, 5, 6, 7, ranging here. Then this one too. So that means it is a valid support because market has actually touched it more than 3 times. But for you to say it is a support, market needs to just touch it 2 times. But for you to say that okay, this support is actually valid, which means that okay, whenever market gets back there in the future, market is most likely to respect it. So you understand? So that is that about support. Then resistance. If you look at your resistance, and its market has touched it. Market has touched it. What brings about the ideology of these things is that you know you it's it's just like you throwing a ball on the floor. Whenever you throw a ball on the floor, the ball is going to bounce up, come down, bounce up. It depends on the kind of force or friction. And sorry, depends on the kind of force or pressure that is being imputed on the ball or is being exerted on the ball. Shey you understand? So if the buyer's pressure is more than the seller's pressure, the buyers are going up, right? So they are going to break the resistance. But if the seller's pressure is more than the buyer's pressure, they are going to break that support. Shey you understand? So that is what they mean. And it's just like you throwing ball. Depends on where the ball exerts most force. You understand? If there's force on your ceiling pushing the ball down, that means your ceiling is going to push the ball to the downside because of the pressure that the ceiling exerted on the ball. And if it is your floor that has more pressure, it's going to break your wall and your ceiling and go to the upside. Shey you understand? So that is what they mean by support and resistance. However, there are things that you need to consider in your support and resistance. Look at this support now. It covers weeks. It covers weeks of candles, right? So that is how you should draw it. You should cover the weeks and make sure you have the highest touches on it for it to be able to say, okay, this is actually valid. So you understand? It covers the weeks. And if you look at it, it covers weeks. So those inside of those my rectangle is called what? Inside of those um rectangle is called zone. Shey you understand? You call them zones. We call them zone. We call them zones. Let me write it out. We call them zones. Inside of those rectangles that you are seeing wicks and some bodies of candles, they are called zones. They are called zones. And they are called zones. Even the zones here too. Inside those rectangles, it is called zone. So the distance between your support and resistance is called range. That is why they call it a ranging market. I hope you dig now. That is why they call it a ranging market. The distance between your support and resistance is called range. The distance between your support and your resistance is called range. So the next thing I would like to talk about now is what is known as break and retest. I would like to talk about break and retest. But before, let me clear all these things. I would like to talk about break and retest. And mostly, break and retest works mostly on a consolidating market. So that is why you should know how to draw your support and resistance effectively. You understand? Let's assume that this is a resistance and a support. So what happens whenever this is a support at this level? So what happens whenever market gets to a support? It's gonna buy, right? Whenever it hits your resistance, what's gonna happen? It's gonna sell, right? It's gonna buy, it's gonna sell, it's gonna buy, it's gonna sell here. So there's now possibility that okay, the sellers have more pressure than the buyers, and they decide to just break this your support. This is the support. So now after they've broken your support will become resistance. Why? Because market is under it. Like I said in the beginning, that whichever place the market is below is known as what? Is known as resistance, and whichever one market is above is known as support. Now in this case, market is below this one, so it is known as resistance. So now for you as a trader to be able to take advantage of this thing, you need to wait for the retest. That means you have, after the break like this, you have to wait for market to come back to this resistance, test it. After you see series of candles testing it, then you can now decide to sell to whichever way you want to sell to. I hope you understand what I'm talking about. At the same time, while you are looking for a support and resistance, there's something we also call fake out. I forgot to show you here. Let me show you an example of fake out. When you look at this place, there's there are some candles that just came out of those zones, that came out of your support. It is known as a fake out. Why is it a fake out? Because market actually pulled back into your support and resistance and continue to respect it. Can you see? Market pulled back, market pulled back into this resistance, respected it, came down again. So that is why this one is called a fake out or FU candle. Okay, you understand? So this is how break and retest actually works. So, and it is not in all cases that whenever market breaks your resistance or support that you are going to see a retest. Okay, you understand? So let me show you some examples of break and retest before we actually move to the next stage. Look at this. Look at this place. This is the resistance here, and this is the support. See what I'm talking about? Why is this upward side? Why is it? What am I doing? So can you see it clearly now? So if you look at it very well, if you look at it very well, this is why is it? Why is this place? Why is it a resistance? Because when market touched it, it fell. Then why is this a support? Because when market touched it, it went up, and this resistance came down again, went up. Then due to the fact that the buyers have more pressure, they have more energy than the sellers. See what happened? They broke it. So after breaking it, they came back to retest it. So now this resistance has turned into support because market is now above it. So can you see? And they bought after a series of tests here. Can you see the way they tested it? And they bought. They came back again the second time. They bought again. It shows that they actually respect that level. Sure, you understand. So that is that about support and resistance. Sorry, that is that about break and retest. Look at this place too. So now the rest is left to you to be able to detect those things. That is why you need to configure your eyes. So can you see when market broke this resistance, see what happened? Came back to retest it and then started going up. So that is that about break and retest. So the next thing now I want to show you guys is key levels. I want to show you key level. What do they call key level? Key level are actually areas that are being respected by the market. They are just like support and resistance. You understand that market has respected in the past. You understand? There are just areas that market has respected more than one or two times in the market. in which you just have to take advantage of. Do you understand? You just have to find those levels that market has respected more than two times, and this is what you make use of while doing that. You make use of your horizontal line. Can you see it? Horizontal line. That is what you make use of if you want to get those levels. So now let's look for levels with which market has tested more than two times in the past. So those will give you potential targets for where to actually put your take profit or whatever. Sure, you understand? So now market has respected it here when it here one, two, three, four times. So that means it is actually a valid level which is acting as resistance because market was below it before it now broke it. So now market has broken it. So now can you see that market has broken it and then came to retest it, went up a little bit before it came down again. So we have a lot of key levels. You understand? It's just that you have to note them. Like market must have tested it more than two times. Look at this one. So this is also a key level. Can you see the way market tested it three times? Can you see market has tested it three times? Three times. One, two, three. So if you go back to the past, market must have respected those levels. See the way market sniped away from it. So market must have respected it in the past too, because that is how those key levels are. You understand? See it here too. See it here. When market touched it, see what happened? It went up. For those that's that about key levels. You just have to find areas with which market has tested more than two times. So now look at this point too. Look at this place too, which is acting as support. If you actually put an horizontal rate there too, you will see that market has tested it in the past more than, let's put it there, more than two times. So let's look at the past. I think market is currently there. So let's just check what market is doing because market is currently there. Let's see what market is doing. Let's see here. When market go there, see what happened. Went back up, then broke it, then came to retest it, then started going. So can you see what happened here? We respected it. Can you see what happened? So can you see market is currently there and respecting it, here to respected it, here to respected it. So that is that about those two levels. So the next thing I want to talk now about is trend line. How to draw a valid trend line. For you to say you have trend line, it depends on how how you understand market structure. So you understand. You have to understand market structure. So you understand like all those your high highs and high lows and lower highs for a downward trend. Because the essence of using trend line is that it actually helps to know where market is heading to. So now for you to say you actually have a trend line, market has to have tested it like two times. What do I mean by test? I mean market must have touched it like two times. So that means you have a trend line. But quote me, there's difference between a trend line and what and a validated trend line. For you to say that okay, you actually have a validated trend line, that means market must have tested it more than two times. Why? Because market must have tested it more than two times. Sorry, more than three times. So because whenever market gets back there in the future, it means that market is actually going to respect it because market has tested it. Market has tested it for more than two times. Sure, you understand? So now, when you want to draw your trend line, you should always consider two things. Either you join the wicks. So these are wicks or shadows of your candlesticks. So you make sure that you join wicks together or you join maybe beginning of the body. I hope you can see. So now if you want to join your trend line, it should just be wicks. It should not be touching the body of your candlestick. And if it is the body you want to make use of, it should be touching the body, not like it should not be crossing it like this one. Like I said that this one is crossing the market already. You understand? It should not be crossing the market. It should just be at just the tip. So me now, I make use of wicks so that I won't cross the body of my candles. I make use of weeks. Shey you understand? So so same thing that happens to your break and retest for your ranging market also happens for your trend line. Market can also break and retest your trend line. Shey you understand? So this is trend line. Let's look for more examples on trend line. So there is no specific ways with which you can draw your trend lines. Shey you understand? You just have to make sure that you are actually joining things together. Shey you understand? You are actually joining things together. That is how to go about the trend line. That is how to go about trend line. I don't know why this thing is slow. I'm looking for more examples. So let's look for more examples. Let's look for more examples. Look at this. So this shows that this shows that we are on a downward trend. Can you see it? See what happens. Market when market touched it here came back, but not yet a trend line. Touched it here, came back, but not yet a trend line. So this third time now makes it a valid trend line. So you cannot take advantage of it at this fourth time to sell. You can also take advantage of it at the third time. So you understand? To actually sell. The first two touch, the first two touch made it a trend line, but that third touch, rejecting it back, makes it a valid trend line. So you understand? You could have easily take advantage of it and just sell the downside. So you understand? So there is no specific ways with which you can draw your trend line. You can just draw it anywhere. Or just make sure like at least two things are touching. You understand? Just make sure that at least two things are touching. So this is if we look at this place too, we can also find some trend lines drawing here. So can you see it? So there is no specific rule. Everything has just do with touches. You understand? So there are no specific rules with which you can draw your trend line. You understand? So the last thing I'll be talking about is how to make use of your Fibonacci. How to make use of Fibonacci tool. That is where I'll be ending the class tonight. Fibonacci tool is actually used for you to measure retracement. Do you understand? It is used for you to measure retracement move. Do you understand? And it is expected that after an impulsive move, it is expected that market should make at least 50% retracement of the move. So you take your Fibonacci to start from your swing low. If you're on an upward trend, start from your swing low, then take it to swing high. to your swing guide. Let's assume that this is where market is presently before it started falling. Let's assume that market. Let me delete my Fibonacci. So let me delete let me delete my Fibonacci because I want to show you something. So let's assume that this is where market is presently. This place is where market is presently, and you want to take out because you know okay, market is going to fall, and you want to take advantage of it. All you have to do is just to take your Fibonacci, take it from your swing low, take it from your swing low, then take it back to your swing area that market started falling. So for you to be able to measure the retracement move. So now let's look at it. So now let's look at it. On that Fibonacci, there are some important levels that you need to know to understand. Like I said, market needs to make at least 50% retracement. Like it should retrace. Do you understand? Like there should be a pullback after an impulsive move. This is an impulsive move to the upside. From here to here is an impulsive move to the upside, and then market started falling. That means there is a retracement of that impulsive move, and the least is 50% of the move. So look at this place now. Can you see? This is 0.5. So 0.5 actually means 50%. So these things, can you see what happened at this 0.5 level? Started going up again. So that is how to go about those things. And these things about this Fibonacci are just like they are just like mathematical tools which are used for measuring retracement. You understand? There are tools which are used. So let's check another example with which we can make use of. I'm gonna release another video which is going to talk about indicators and Fibonacci retracement and Fibonacci extension. You understand? So now this is a move. This is a move from this place. Let's assume that this is where market stopped before it started doing what? Before it started going up. So now that means you know that okay, you're on a downward trend, right? So now you have to take your Fibonacci, start from your swing high here, then draw it back to your swing low. Take your Fibonacci, start it from your swing high, then take it down to your what? To your swing low. Take it down to your swing low. Can you see what happened at this 0.5? See what happened at 0.5. So like I told you that it is expected when you notice that okay, market is actually going up again. That means market wants to go and make a retracement move of that impulsive move. Can you see what happened? It retraced at that 0.5, then started falling. So I hope you understand how to make use of those things. And in case you have any question, please slide into my DM. I'll always be available and ready to help you with any ever issue you are going through. So just like the example of the support and resistance that we are talking about, this is a resistance. Now see what happened. Markets have started falling already, and here is your support. That means if you want to be trading this, that means you are going to sell from here and your take profit will be this level because this is your what your support because market has made like 4 touches on it, which makes it a valid support, and this is your resistance. So market has been respecting it as you can see. So that means you're gonna sell. So I'm gonna end this session. In case you have any question, let me know please.